here today. So financial institution. Okay, basically that's the learning objectives for this chapter. So the learning objectives, we talk about the financial intermediation. Okay, financial intermediation and the roles of financial institutions, and define commercial banks, explain how reserves requirements influence their operations, and describes the we talk about, okay, let's see, the Federal Reserves, and how they regulate financial institutions, and how the savings and the loans association differ from the commercial banks, and how credit unions operate. Okay, that's financial institutions. So remember, we talked about the economic units is going to be savers, and you have borrowers. So the savers, they have money. The borrowers, they need money. Okay, what they do is that they are not going to go to the directly. So they goes to the third party. The third party is we call the financial intermediaries. Third party financial intermediaries. So the household, when you see the household and the, so let's go here. See let me open this. Okay, so you can see the household with surplus fund. So that means they have money. So surplus fund, and those are the household. Okay, they can purchase a saving account at a financial institution. And also you have surplus, that means they have money. Okay, savers. So we have savers, right? So the services offered by financial institutions. So next we talk about the services. So basically they do denomination matching. Okay, denomination matching. So what denomination matching? Denomination matching is the household generally have a small amount of surplus fund to invest, and they can put a small amount into saving, so the saving account. So we do, this is the code denomination matching. So those who need loans, usually they requires the larger amount of fund, and then those they can borrow for business, or they can borrow for a home, or they do a home mortgage, or is a car auto loan. So that's how the service was provided. So the services we can see offered by financial institutions is they serve as the third party. Okay, they serve as the third party. third party, you can see this is basically this are the two. Okay, you can see that on the top here is surplus economic unit. That's EU. There's a surplus economic unit, and this is the one. The DEU is a deficit economic unit. So the deficit economic unit, they need money. Okay, the surplus economic units they have money, so they can go through financial institutions. Okay, through financial institutions, so that's the middle or the third party. So basically, when talk about the financial institutions, those are the financial organizations. They serve as the third party, served as a third party. So, and we just briefly talking about what types of financial institutions typically we use. Okay, and the the services offered by financial institutions, one thing is called denomination matching, and also they have maturity matching. Okay. The large amount, how much money you need, and also you wanted to how long, okay, how long those people they need. Some of the loans be short term, and some of the loans will be long term. Okay, basically, they do denomination matching and maturity matching. The financial institutions, they absorbing the credit risk. Okay, so if you have individual like lenders, okay, if you do borrowing, and it's hard to measure the risk. The borrowers, they need to have checked their credit, okay, check their credit. So the lender, sometimes they cannot do that if you do both way or directly match those transactions. So then the third party says they have more professional ways and to reduce or minimize the risk. Okay, so absorbing the credit risk. And the banks, they can loan this money to a more trustworthy parties, so they can put them in a portfolio or bundles to reduce the risk. So that's how and why the financial institution, they survive. Okay, so we can see the financial institutions basically they help to facilitate the flow of funds in financial market. So this they basically that's the role of financial institutions. Okay, so this like say give you an example of the commercial loans, and this is going to be provide investment bank that they do in stock and bond. Okay, so here I wanted to know what exactly the difference between commercial banks and the investment bank. Okay. Do you know the difference between commercial bank and investment bank? So let's say this is like a financial intermediaries for example one. Okay, example one, and we see in the middle, this is a commercial bank, right? So the commercial bank, so, and then we do here, and you see this is a insurance company or the third party. Okay, so basically Okay, this is the difference between commercial bank and investment bank. So the commercial bank, they help you to open a checking account. You can see this they do checking account service. Okay, for household. The investment bank, can you open a checking account with investment bank? Yes or no? Okay, investment bank business is doing like issuing stock and bond for business. Okay, it's not going to have a doing deposits service. Okay, that's the major difference. Okay, when you tell this bank is a commercial bank or that bank is investment bank, is that the only commercial banks, they take deposits and help with their checking account, but for investment bank, they don't. Okay, they don't. Okay, so that's something we talk about. And let's see, so which banks you think in the United States are commercial bank, which one are okay, let's see here. So the major U.S. investment bank. Okay, I'm not sure you can see that. Major U.S. investment bank. Okay, you can see the top one. The largest investment bank is JP Morgan Chase. JP Morgan Chase is that JP Morgan is investment bank or that's a commercial bank? Do you have a checking account with JP Morgan? Yeah, or a savings account, or can you do that? What do you think? JP Morgan is, why they list as the largest investment bank? Okay, they can do both. Okay, so that's so the JP Morgan Chase is both a commercial bank and investment bank. So they do both, and I will tell you later. Okay, so before it's not allowed, and then they have a new law is called bank deregulation, and some of the bank they do commercial bank and also investment bank. Same like a Citigroup. Okay, Citibank you can have a Citigroup is doing the same thing. Okay. Bank of America is investment bank and commercial bank is that. So the investment bank part for Bank of America is Merrill Lynch. So when you see that 2008, so the Bank of America took over Merrill Lynch. So Merrill Lynch is the investment bank part of the Bank of America. So Bank of America, they do commercial bank and an investment bank. And Goldman Sachs is only investment bank. Okay, Goldman Sachs never do a commercial bank. So you don't have that commercial bank business, or you cannot like open a checking account with Goldman Sachs. Morgan Stanley, the same thing. Okay. So some of the bank, they do commercial bank, some of the banks, they do both, and some banks, they do only investment bank. Okay, so that's some clarification right here. Okay, so first we wanted to know the commercial bank. So what does a commercial bank do? Okay, the commercial banks, they took in business commodity deposit and to lend foreign to business. Okay, they do have take your deposit commercial like individuals, and the commercial bank they took business deposit. Okay, the commercial bank they lend money mainly to business. Okay, so you can see this is for business commercial bank. How they make money? They make money based on took deposit from the business and lend money to the business, small business, large business. Okay, so when you graduated, you get a job in the bank. So the customer relationship is very important. So even you work in a bank, you need to find some big customer, especially some big company, and they put their money in your bank. So that's important to do the customer relation. Okay. And then the bank, they need money, and your bank will help to lend money for some short-term or long-term use. Okay, so commercial bank, the main business is focused on business. Okay, that's some of the students, they have misunderstanding. They think, oh, that's I have a good relation with, like, I have a check-in with JP Morgan Chase, for 10 years. Okay, that's an individual. Okay, but it's not their main focus. Okay, main is business. Okay, and so commercial banks. Next, we have saving and loans. Okay, savings and loans. So savings and loans. What is savings and loans? Okay, savings and loans are primary purpose is to taking deposit from a household and a land fund to home mortgage. Okay, this is a savings and loans. Sometimes we S and else. Okay, we call it savings and loans. So savings loans are they took a deposit from a household and to for home mortgage, and then that's fund for home mortgage. So like a Quicken Loan, and have you heard that? Quicken Loan, they do home mortgage. Okay, next is called credit union. Okay, credit unions are owned by depositors and who are individuals. So sometimes you can see they have teachers credit union or some particular area of these people. It's individuals. Okay, credit union is serving for some particular groups of people, individuals. So what are the difference between like a savings and loans and the credit unions? The credit unions, they take in fund and they make a personal loan. Okay, they make a personal loan. So both of them, okay, they took money from household, but they make a personal loan. Okay, the primary goal is to do personal loan. But however, for like a S&Ls, the goal is for mortgage. Okay, the goal is for mortgage. Okay, so we call all those depository institution. Okay, so what is depository? Do you know what is depository means? Because the source of their money. okay, the money, the dollar, the source, okay, is come from deposits. Okay, the source of their fund come from deposits. So either from business, they deposit money, or either from household. So that's where the money comes from. So you look at the commercial banks, okay? They took your money and then you lend it to someone else, right? Lend to someone else. So they make the difference, the interest rate. They charge a different interest rate. Okay, you put in your money in JP Morgan, they pay you like a 0.25 interest rate. And then the banks lend that money out, they charge 3.75%. Okay, they make the difference, okay, take the difference. The savings and loans are the same thing, okay? The mortgage rate and the credit unions, okay, they make loans to particular groups of people. So they deposit to an institution. That means those institutions, their fund resource mainly come from deposits. Okay, so next group, so we have non-depository. It's not only all those money the money they come from deposits. Okay. So another groups, one of them is called a finance company. Okay, finance company are non-bank firms that borrow funds to make short-term or mid-term loans to high-risk borrowers. Okay, we call them finance companies. Okay, finance companies. So, for example, you have some big companies like JP Morgan is a bank, but for ExxonMobil, say ExxonMobil, they have their own finance company. Okay, their own finance company, and some of the like a Toyota, right? Toyota or Honda, they have their own finance company. So when you go to buy a car, so they have a Honda financial service company. They provide you the auto loan. It's a part of the Honda company. So some of the companies, they have their own finance companies. So where the money they come from, let's say Honda Finance Company Services. Okay, they provide you the auto loan. Does that company, they took a deposit from the individuals? No, they don't, right? So those companies, they have their own fund. Okay, they have their own fund. So that's companies, they don't have deposits. The source of fund are not dependent on the deposits. Okay, next we talk about the insurance company. So when you look at the insurance company, the insurance company, where the money comes from? Where the money comes from for insurance company? Okay, let's say this called a premium. Okay, they have an insurance company, they have premiums. They have premiums. So these are premiums for insurance policies or insurance companies. Okay, so those are where the money they come from. They sell insurance policy. Okay, the policy holder, they pay premiums. Okay, those insurance companies, they could be like sell life insurance or this property insurance, and it doesn't matter, what kind of insurance they do, but they receive premiums. And another type is called pension fund. And when you see the pension fund, so what that means, pension fund. The pension fund is for the retirement, for long term. So the workers, they contribute fund to their retirement. Okay, the pension fund is for retirement money. So when you contribute to your retirement, those money goes to the pension fund. And that pension fund is like a mutual fund. They help you to manage your money. And you cannot withdraw the money, okay, until you are 65. Or some of the fund allow you to withdraw when you are 60. But you're starting to contribute when you are young. You cannot just wait until 60, you're starting to contribute and you don't have money in that pension fund. So those pension funds are starting to accumulate and help the customer to earn more and more money. Okay, but those funds are starting to distribute those money until the customer at a certain age. So this could be a defined benefit plan or the defined contribution plan. So there's two different types, okay? Defined benefit plan and defined contribution plan. So you can do some research. So what is the difference between defined and benefit plan and the defined contribution plan? Okay, so if your company, you go to looking for a job, you go to the HR, they talk about, we have the retirement plan is called defined benefit plan. So do you understand what that means? Okay, so you need to think about, okay, so which type of plan is better for you? And some of the company, they have a defined contribution plan. So make sure you understand the difference, the insurance company and the pension fund. Okay, so you can see all those are three different types. The financial companies, insurance companies, and pension fund. Okay, all those are non-depository. Okay, non-depository, that means those institutions, they got money, not depend on deposit. Okay, the finance company, they got money from the business. Okay, they have their own source of fund. And insurance company, they got from premiums. And the pension fund, they got from the pension. Okay, this is retirement. Okay, retirement. So here are some of the people, they got 401k, 403b, right? So those are the money they contribute to their pension. Okay, so any questions? Okay, let's see. We have some of these the contents. Okay, so other than those different type of financial institutions we have mentioned here, and they talk about the mutual fund. Okay, mutual fund. So there are a lot of people, they don't have time or they don't have knowledge, so they can invest their money in mutual fund. Okay, mutual fund. Mutual fund is also a good way for you to invest. Okay, and mutual fund is basically they have professional managers to help you to manage your money. Okay, help your money. So that's a mutual fund. And okay, any question about this part? Okay. And so one of the things that I want you to know is they call the reserve requirement of depository institution. And so you see the commercial banks. Okay, when you go to any commercial banks, there is one. You can see the plate is called FDIC. Okay, FDIC insured. Okay, FDIC insured. Okay, so you go to the JP Morgan or go to Bank of America, and you can see the plate put in there is FDIC insured. So that means the bank, if that bank is a bankrupt, you can get up to 250,000, okay, US dollars. Okay, this bank is insured. Okay, and so in order to get the license to accept the deposit, and you have to be insured by the Fed, okay, the Federal Reserve. So the Fed ensures that institution have some liquidity to meet demand for withdrawal and help to control the money supply. So that's very important. So what about you have money and you have, let's say, you have 500,000. If you have 500,000 and put 250 in one bank and another 250 another bank. Okay, for example, in that the Bank of America, the bankrupt, you still have money you can get from JP Morgan. So that's the only insure up to 250,000. That's the new regulation after 2008 financial crisis. Okay, before it's only 100,000. 100,000. So if you put a lot of money in one bank, for example, in the 2008 financial crisis, Lehman Brothers bankrupt, and there are hundreds of like a small bank that bankrupt in the whole nation. Okay, so if you didn't know that, okay, so the money above that 100,000 will lost if that bank is bankrupt. Okay, don't think, oh, that's a big bank, that could not happen, but it could happen. Okay, it could happen. So so make sure so your deposit, okay, is insured. Okay, all the financial institutions that take deposit or take your deposit, okay, it's insured only up to 250,000. Okay, any questions? Have you ever heard of that? No? Okay. So now is that, okay, it's very important to know that, okay. If you have more than 250,000, you better to consider to put in different banks, okay. And that is for the safety, okay, for the safety is do not put all your eggs in one basket. It's only insured up to 250,000. That's the reserve requirement. Okay, so you can see for the banks, all the banks, all those financial institutions are regulated by the Federal Reserve. All of them are regulated by the Federal Reserve. So what is the Federal Reserve? The Federal Reserve is a central bank, okay? So in the United States, we call the Federal Reserve. Okay, In all other countries, we call this is called a central bank. Okay, all other countries they call central bank. The central bank is the bank of the bank. Okay, or the bank of bank. And so what that means, the bank of bank is the bank regulate all the other banks, monitor all those other banks, supervise all the other banks. Okay, so the Federal Reserve, they make laws and regulations, and they put final support of all those banks. It is a very important institution. Okay, so when the U.S. government, you make the United States, the Treasury, U.S. government, they need money, as they got money from the Fed. Okay, the Fed. So where the money come from for the Federal Reserve? Why the Federal Reserve could have, so much money? Do you know why and where they can get money? No. Okay, the Fed, they got money from, they could print. Okay, they could print. So that whatever amount of money they want, they can print. Okay, it doesn't mean they have to, it's like the more money you print, that's gonna lose the value. It causes inflation, right? They cause inflation. It's and they can print. Okay, it doesn't have to print that much. Okay, but they can print. Okay, I will show you this is one of the country. They print how much money they print. Okay. Okay, there is a country in Africa. It's called Zimbabwe. Okay, Zimbabwe, they have a currency, and that's what they have. Okay, so they can have a $100 trillion banknote. Okay, you look at this. Okay, we have $1 bill notes. The maximum we have is 100, right? 100. So you can print. But Zimbabwe, they can print. Okay, that's the same size like a US dollar or $100 bills. Yeah, that is 100 trillion. The 100 trillion. So that is means, whatever amount it can print. Whatever amount it can print. So even if you want to save paper, so you can print. Okay, this is 1 trillion, whatever. It's just, print. So that's why you can think, okay, you think the Fed, how powerful, whatever amount they can print. Okay, they can print $1 trillion bill, whatever. Only the Fed has that authority. They can't do that. Okay. The thing is that the more money you print, the more like inflation. Do you think that Zimbabwe, you have 100 trillion, are you rich? You can buy a lot of stuff? No, it's just so, trash. Those are like, even you have 100 trillion, it's a trash, okay? You cannot buy anything. If the Fed, they keep printing money, is like a printing a lot, the paper will become a trash. It's the same thing. Okay, so now I wanted to show you this is your question. Okay, I'm asking you the Fed. Okay, the Federal Reserve System is called fractional. Okay, the Fed is a fractional a reserve system. So what do you mean as a fractional? Okay, so this is called fraction. The Federal Reserve is called a fractional reserve system. So that is, they have a 12 district. There's 12 districts. Okay. 12 different districts. So you can see the Federal Reserve, they have the board of Washington, D.C., and then they have 12 different districts. Okay, the one in California, this is San Francisco, and they have Georgia. So do you think there is one in Houston district? Do we have like a Federal Reserve, like a district in Houston? No. Where is it? Is Texas has one? Austin? Yeah, they do have one in Texas. There's a red one, see? Here, so do you know which city we have? The Federal Reserve District. There's only 12, okay, only 12. So Texas has one, California has one. California, that one is in San Francisco. In Texas, it's not in Austin. It's not in Houston. It is in, no, it's Dallas. Okay, there's one in Dallas, okay, in Texas. That's called a fractional, okay? Fractional district. So, you know, why you got a district and a regional district Fed bank is so important? Because the Fed, they do several things. Okay, those things, the very important, okay? Very important thing. The Fed is the central bank. So of course we know the central bank. Okay, I will talk about, okay, the central bank. So the central bank, they do a money supply. Control the money supply. Okay, how much money is supposed to supply in the United States? Okay, they do money supply. Okay, so they determine how much money they print, and they determine how much money the whole society need. That's so important. Okay, so important. So we wanted to show you the Federal Reserve is also the lender of last resort. Okay, the lender of last resort. Okay, so any commercial bank, or financial institutions, you don't have money or you want money, okay, you can ask the Fed for money. Okay, ask the Fed, how are you gonna do that? Okay, the loan, all those receipts you have, you just take a discount, okay, you discount and as like a collateral, and then go to the Fed, and the Fed will provide money for you. Okay, that's the talking about the current. They have the pandemic is that the Fed can buy those receipts from the commercial banks directly, okay, and they provide whatever the amount the commercial banks they want. They just take a discount. Okay, for example, like JP Morgan, they wanted to have money. Okay, they need money. They come to the Fed. They say, okay, this is a Georgia, and Georgia they have and this is the loan, okay. And they ask the Fed, okay, you can take this as deposit, and you provide me not 100. The loan amount is 100, so it just give me 85. Okay, they take a discount from the Fed. The Fed will be the lender of last resort. And also they do check clearing. Okay, this is another rule. Okay, check clearing. Okay, there are different types of financial instruments. All those instruments, it goes around, and then the Fed will do the clearing. Okay. Okay, so the another role of the Fed is to bank supervision. Okay, the bank supervision, they supervise, regulate all the other banks. Okay, supervise or regulate all the other banks. The banks, the structure of the Fed is including 7 members. Okay, 7 members. They form that board of governors, and they have 7 members, right? And then it's located in Washington D.C. and they have a chair. Okay, and they have the Federal Open Market Committee. Okay, this is a very important committee because all those important information about the unemployment, or they have some policy changes, and we'll go through that Federal Open Market Committee. They decide how much money they inject into the market, and how they sell or buy the treasury securities. And the Fed, they have we talk about is one board of governors, and they have 12 Federal Reserve district banks. Okay, district banks. Those are called district. So they form a system is called fractional Federal Reserve System. Okay, how the Fed influence interest rate. Okay, this is the other 3 ways. Okay, one is open market, and the second is the discount rate, and the third is called reserve requirement. Okay, that's the important, most important information that we need to spend the next class to talk about this. It goes to some of the more details about how the Fed influence money supply, and how the Fed increase or decrease interest rate. Okay, so we go to the okay, so we have this one, the fractional reserve banking system. Okay.
Fractional reserve banking system is when
Okay, so I hope you understand this. Okay, it's a little bit, you see that's a little bit complex, but the key concept is that the bank is not going to keep all that money 100%. They only keep a fraction of it. Okay, a fraction of it, and the reserve requirement for the case we talk about, okay, the bank is only keep about 20%. Sometimes, so most of the time we use is a sell suggestion is only like a 10%. Okay, they could lower to 8%. So you can see the multipliers is more likely about 10 times. That's how the money supply was created. It doesn't mean, okay, the Federal Reserve, let's say the Federal Reserve, they print or they have 1,000 money supply, but in the whole system is going to generate 10 times more, okay, 10 times more. That's because of lending and borrowing of those, the bank system. And actually this is going to interpret the result of the, currently you see a lot of people, they lost a job and they are revenue, the household income decrease. Okay, a lot of people, they lost a job. And however, when you look at the house market in Houston or in the big cities and the stock market, you look at that, did you notice the house market in Houston is booming? Yeah, a lot of people rush to buy houses. It's a good real estate market and a good stock market. You look at the stock price. The stock price and then double and triple and then jumping up. So the index never go down. So that's how you can see what happens in the economy. And okay, that's I think that's all. So what I just have a 3. So I just wanted to let you know your name for today. So, and what's your name here? Maurice and Diego and Reina. Okay. Yeah. So hopefully the lectures was recorded successfully. So and that's I think that's all for today. And okay, see you on Wednesday, Thursday.